Question 1. From the perspective of underwriting practices in commercial property insurance, what is the primary risk consideration when a building remains unoccupied but not vacant for an extended period? A. The policy automatically terminates after 30 days of non-use. B. Coverage remains unchanged regardless of use. C. Limited coverage applies if over 60% of the building is not rented or used. D. The building is excluded entirely from the policy. Answer. Correct answer. C. Explanation. In Colorado, under the ISO commercial property policy, a building is considered vacant if less than 31% of its total square footage is occupied. The standard policy language includes a vacancy condition that reduces certain coverages after the property has been vacant for more than 60 consecutive days. If the building is merely unoccupied but not vacant, e.g., temporarily not in use but furnished or undergoing minor repairs, coverage might continue but still faces scrutiny. Underwriters assess this as a higher risk due to increased exposure to vandalism, undetected damage, or fire, while policies don't automatically terminate. Losses caused by vandalism, sprinkler leakage, glass breakage, water damage, theft, or attempted theft may not be covered. RAF ISO CP 010, the Colorado Division of Insurance Regulation 5114. Question 2. Taking into account a scenario involving Mr. Franklin, who owns a commercial bakery, what is the purpose of including a business income and extra expense endorsement in his property policy? A. To provide reimbursement for damaged inventory only. B. To pay for employee wages even after the business resumes. C. To cover lost net income and necessary expenses during restoration. D. To ensure physical damage to leased bakery equipment. Answer. Correct answer. C. Explanation. The business income and extra expense coverage form CP 030 is critical for businesses like Mr. Franklin's. It pays for loss of net income due to covered cause of loss that results in necessary suspension of operations, and it also pays for extra expenses incurred to minimize that suspension. This endorsement does not cover inventory losses or physical damages. That's the role of the building and property form. It ensures continuity by supporting payroll, rent, and temporary relocation expenses. In Colorado, this is considered core element of financial recovery planning. Ref ISO CP 030, Innate Commercial Property Model Regulation. Question 3. In light of recent developments, which of the following best exemplifies a speculative risk rather than an insurable pure risk? A. A hardware store facing potential theft during a riot. B. A business losing revenue due to a product recall. C. An investment firm's stock portfolio fluctuation. D. A warehouse susceptible to flooding. Answer. Correct answer. C. Explanation. Insurance deals primarily with pure risks, which involve only the chance of loss or no loss, not gain. Speculative risks, like investing in stocks, involve both potential gain and loss and are not insurable, while losses due to riots, recalls under certain coverages, or flooding, if insured, are pure risks. Investment losses are considered voluntary and speculative. Colorado insurance law prohibits under speculative risk due to its unpredictable and unquantifiable nature. RAF Colorado DOI, Risk Management Overview, Innate Fundamentals of Insurance. Question 4. Given the circumstances surrounding Is Lucia's commercial cleaning company, which has suffered repeated losses due to employee theft, which type of policy should she prioritize to mitigate future risk? A. General liability insurance. B. Commercial auto coverage. C. Employee theft crime insurance. D. Professional liability insurance. Answer. Correct answer. C. Explanation. The employee theft provision under commercial crime insurance provides coverage when an employee steals money, securities, or property from the employer. This is particularly crucial for businesses like Is Lucia's that rely heavily on access to client premises and trust-based services. General liability would not respond to employee dishonesty, and commercial auto covers vehicles. In Colorado, this type of crime insurance is written as part of Commercial Package Policy (CPP) and is governed by ISO Form CR01. RAF ISO Crime Coverage Forms, a Colorado DOI Regulation 5110. Question 5. While examining a claim situation, Mr. Jordan files a commercial property claim after storm damages his building. He has a coinsurance clause of 80% and insured the property for only 60% of its replacement cost. The loss was $200,000. How will the insurer likely respond? A. The insurer pays the full loss amount. B. The claim will be denied entirely due to underinsurance. C. The insurer pays a reduced amount due to coinsurance penalty. D. The policy is cancelled retroactively. Answer. Correct answer. C. Explanation. Coinsurance clauses are designed to encourage proper insurance to value ratios. If the insured fails to insure the property to the required percentage, here 80%, they come a coinsurer and absorb part of the loss. The insurer will apply the coinsurance formula. Payment equals amount carried amount required x loss text payment equals left frac text amount carried text amount required right times loss payment equals the amount required amount carried x loss equals 60% x equals 150,000 equals left frac 60% 80% right times 200,000 equals 150,000 equals 80% x equals 150,000. So Mr. Jordan will receive $150,000 and the remaining $50,000 is not covered. RAF. IOCP 010, the Colorado DOI Consumer Bulletin B1.11. Question 6. To illustrate this point, what action should Ms. Nguyen take if her business signs are excluded under her commercial property policy but are vital for her storefront marketing? A. File a claim under business income coverage. B. Purchase a separate signed floater endorsement. C. Submit a request for waiver of exclusion. D. Apply under ordinance or law coverage. Answer. Correct answer. B. Explanation. Most commercial property policies exclude or severely limit coverage for outdoor signs not attached to buildings unless explicitly endorsed. Ms. Nguyen should purchase a sign floater or sign coverage endorsement. ISO Form CP 1410 to protect her signage against perils like vandalism or weather damage. Ordinance or law coverage addresses code-related upgrades. Waivers of exclusions are generally not granted on request without formal endorsement. Ref. IOCP 1410, the Colorado DOI Form Filing Guidelines. Question 7. The effectiveness of an insurance contract relies on certain legal principles. Which of the following best demonstrates the principle of indemnity in a commercial property context? A. Paying the insured more than market value to offset emotional loss. B. Replacing damaged property without depreciation. C. Restoring the insured to their financial position before the loss. D. Allowing profit after a covered loss occurs. Answer. Correct answer. C. Explanation. The principle of indemnity ensures that insurance restores the insured to their pre-loss financial position. No better, no worse. This principle prevents the insured from profiting from insurance and aligns with Colorado insurance laws requiring that claims are measured by actual value or agreed value depending on the policy type. Emotional loss is not compensable under commercial property. Replacement cost options avoid depreciation but still serve to indemnify, not enrich, the insured. Ref. C. SS041110.82 ICP 010. Question 8. By comparing two types of liability coverage, which is true about the distinction between occurrence and claims-made commercial general liability CGL policies. A. Claims-made policies cover claims regardless of when they're reported. B. Occurrence policies only apply to claims made during the policy period. C. Claims-made forms require the event and claim to occur within the policy term. D. Occurrence policies cover events during the term even if reported later. Answer. Correct answer. D. Explanation. An occurrence CGL policy provides coverage for claims stemming from incidents that occur during the policy period, even if the claim is made after the policy has expired. In contrast, claims-made policies require both the event and the claim to fall within the policy term, unless there's retroactive date or extended reporting. Colorado law allows both forms, but insurers must clearly disclose differences per SS041120 RAF ICG01, Colorado Insurance Regulation 5110. Question 9. In response to Mr. Adler's recent policy purchase, is agent issues binder What is the legal function of binder in Colorado commercial lines insurance? A. Provides temporary coverage until the first premium is paid. B. Extends coverage for 90 days regardless of underwriting. C. Guarantees policy issue regardless of risk review. D. Acts as temporary legally binding contract pending policy issuance. Answer. Correct answer, D. Explanation. A binder is a temporary written or oral agreement issued by an agent that provides immediate coverage before the formal policy is issued. It is legally enforceable and recognized under Colorado Revised Statutes SS 04118. The binder must specify the coverage, limits, and expiration, usually valid for 30 days. It does not guarantee final acceptance and does not require prepayment. Ref. CRS SS 04118 and 8 Producer Licensing Model Act. Question 10. Among the various parties involved in a fidelity bond, who is the obligor? A commercial contract setting. A. The person who purchases the bond. B. The insurer guaranteeing performance. C. The party who receives the benefit if the bond is breached. D. The employee accused of dishonesty. Answer. Correct answer, C. Explanation. In a fidelity bond, which is a type of surety bond, there are three parties: the principal, e.g., the business or contractor buying the bond; the obligee, the party protected by the bond; the surety, the insurer. The obligee receives compensation if the principal fails to meet obligations. This triparty structure distinguishes bonds from traditional insurance, where only two parties, insurer and insured, are involved. Ref. Colorado DOI Surety Bonding Guidelines and a Glossary of Insurance Terms. Question 11. The predominant theory suggests that subrogation rights allow the insurer to do what wants. A claim is paid to the insured. A. Retain future premiums for loss prevention efforts. B. Seek reimbursement from third parties responsible for the loss. C. Modify the policy retroactively to reduce future claims. D. Cancel coverage immediately to prevent double recovery. Answer. Correct answer, B. Explanation. Subrogation is the insurer's legal right to recover the amount paid on claim from third party who is responsible for the loss. This principle prevents the insured from collecting twice from both insurer and third party and helps insurers control costs. In Colorado, this is legally supported under C. SS 10411.7 and standard ISO policy language requires the insured to cooperate in transferring these rights. Retroactive policy modifications or immediate cancellations are neither lawful nor typical subrogation mechanisms. Ref. ISO Commercial Lines Manual, C. SS 10411.7. Question 12. When presented with a situation in which Izzy Patel's dry cleaning business stores customer clothing overnight, which coverage is essential to address potential damage to those items? A. Bailey's customer coverage. B. Business income and extra expense. C. Inland marine. Contractor's equipment floater. D. Commercial auto endorsement. Answer. Correct answer, A. Explanation. Because Izzy Patel is legally responsible for customer property in her care, Bailey's customer coverage provides protection for damage to customer goods while in her custody. This is especially vital for businesses such as dry cleaners, tailors, or jewelers. Standard property policies exclude property not owned by the insured, making this specialized coverage necessary. The ISO Inland Marine Form handles this and is recognized under Colorado's Inland Marine Guidelines, Ref. ISO Bailey's Coverage Form, and AIC Inland Marine Guide CODOI Guidelines. Question 13. In the absence of a specific ordinance or law endorsement, how does the standard commercial property policy respond when a municipality requires code upgrades after covered loss? A. Pays full cost of compliance regardless of policy terms. B. Provides partial reimbursement up to 50% of the building value. C. Excludes coverage for costs related to code compliance. D. Only pays if the building was constructed after 2005. Answer. Correct answer, C. Explanation. Standard commercial property policies exclude costs arising from ordinance or law requirements unless an ordinance or law endorsement as OCP 45 is added. This includes demolition costs or rebuilding expenses required to meet updated codes. Colorado follows standard ISO exclusion language, which means insureds must proactively add endorsements to avoid coverage gaps. Ref. ISO CP 10 and CP 45. C. S. SS04101 of Colorado DOI Bulletin B5.3. Question 14. Through the lens of underwriting, what is the insurer's most justifiable reason for declining commercial property application involving structure with outdated wiring and no fire suppression system? A. The property is located outside city limits. B. The business is too new to assess profitability. C. The hazard increases the probability of loss. D. The insured refuses to pay premiums in full. Answer. Correct answer. C. Explanation. Outdated electrical systems and lack of fire suppression are physical hazards that increase the likelihood of loss. Underwriting evaluates such conditions using the principles of risk acceptance and classification. In Colorado, insurers must use actuarially sound practices and cannot decline solely based on zip code or newness of business, but they can deny coverage for increased hazard. Ref. NATE Property Underwriting Guidelines. C. S. SS031104. Question 15. Considering the evidence in Mr. O'Brien's loss claim, the insurer applies actual cash value (CV) instead of replacement cost. What does CV represent in this context? A. The purchase price adjusted for inflation. B. The replacement cost minus depreciation. C. The total cost of rebuilding regardless of age. D. The agreed value at the time of purchase. Answer. Correct answer. B. Explanation. Actual cash value (ACV) is typically calculated as replacement cost minus depreciation. It reflects the property's value at the time of loss, accounting for wear and tear. ACV is the default valuation method unless replacement cost is specifically selected and paid for. In Colorado, policies must clearly disclose which valuation method applies. Ref. IOCP 010. C. RS. SS10411 0.8. Question 16. With respect to Esteban's commercial general liability policy, which of the following scenarios would most likely be excluded under coverage? Bodily injury and property damage. A. Customer slips and falls on freshly mopped floor. B. Damage caused to neighbor's property due to subcontractor error. C. Intentional damage by Esteban's to competitor's equipment. D. Delivery driver is injured while unloading goods. Answer. Correct answer. C. Explanation. Intentional acts are excluded under standard CGL policies. Coverage only responds to accidental occurrences, while coverage will cover slips, subcontractor damages depending on endorsements, and possibly loading unloading. It will never apply to deliberate harm. Colorado adopts the standard ISO exclusion under CG01. Ref. is CG01. C. S. SS04110.9. Question 17. The development of the Terrorism Risk Insurance Act (TRIA) was most influenced by which principle in the commercial insurance market? A. Insurable interest. B. The need to transfer catastrophic terrorism risk to the federal government. C. Coinsurance calculation. D. Excess liability stacking. Answer. Correct answer. B. Explanation. TRIA was enacted in 2002 following 9/11 to ensure the availability of terrorism insurance by creating a federal backstop for catastrophic terrorism losses. Commercial insurers were reluctant to offer coverage due to unquantifiable risk, making federal involvement necessary. The law mandates that insurers offer terrorism coverage on commercial policies with clear disclosure of premium and terms. RAF. Terrorism Risk Insurance Act of 2002 U.S. Treasury TRIP Program Summary. Question 18. In a modern context of cyber threats, which commercial insurance coverage would respond if a Colorado business experiences a ransomware attack that disrupts operations and demands Bitcoin payment? A. Commercial crime. Forgery endorsement. B. Business auto physical damage. C. Cyber liability insurance. D. Business income without extra expense. Answer. Correct answer. C. Explanation. Cyber liability insurance is specifically designed to cover data breaches, cyber extortion, and system interruptions resulting from hacking or malware. Ransomware, which encrypts files until a cryptocurrency ransom is paid, is not covered under standard property, auto, or crime forms unless tailored endorsements are added. Colorado regulators recognize cyber as an emerging risk and urge businesses to cyber-specific policies. Ref. ISO Cyber Suite, innate cybersecurity guidance at Colorado DOI Cyber Risk Bulletin. Question 19. To what degree does the Colorado Division of Insurance require producers to handle client premium funds separately from personal funds? A. Not required as long as monthly balances reconcile. B. Permitted if the amount is under $500. C. Strictly prohibited. Must be held in fiduciary capacity. D. Allowed only with the client's written consent. Answer. Correct answer. C. Explanation. Producers in Colorado are fiduciaries and must hold client funds in a separate account. Commingling personal and business funds is prohibited regardless of the amount or client consent. Violations may lead to license revocation or criminal penalties. This is governed by CRS S027041E. Ref. Colorado Producer Fiduciary Duties Statute CRS S02704. Question 20. As demonstrated by ISTA-Choi's decision to combine its property liability and crime coverage into one policy, what type of policy has he likely purchased? A. Business auto policy. B. Commercial package policy CPP. C. Business owners policy BOP. D. Workers' compensation master plan. Answer. Correct answer. B. Explanation. A commercial package policy CPP allows businesses like ISTA-Choi's to bundle multiple lines of coverage, property, general liability, crime, inland marine, into single customized policy. Unlike BOP, which is for small businesses with specific eligibility, CPP offers greater flexibility and customization. In Colorado, insurers must provide clear summaries of all coverage parts within the CPP. Ref. Our CPP Guide, a Colorado DOI Commercial Lines Filings Manual. Question 21. Considering the evidence, ISTA Ramirez runs a landscaping business and leases a storage shed on a client's property. If his equipment is damaged while stored there, under which type of coverage would he most likely file claim? A. Contractor's equipment floater. B. Bailey's customer coverage. C. Business income and extra expense. D. Commercial general liability. Answer. Correct answer. A. Explanation. A contractor's equipment floater covers tools and equipment owned by the insured and used in their business, regardless of location. Since the equipment is stored on leased premises, this coverage protects against physical loss or damage to such equipment. Bailey's coverage protects property owned by others, not the insured's equipment. Business income and liability coverages do not address physical loss to owned equipment. Colorado insurers recognize contractors' floaters as vital for mobile businesses. Ref. ISO Contractors Equipment Floater Form, the Colorado DOI Inland Marine Guidelines. Question 22. With respect to Colorado cancellation laws, if a commercial insurer wishes to cancel a policy midterm for non-payment of premium, what is the minimum notice period required? A. 30 days advance written notice. B. 10 days advance written notice. C. No notice required if premiums are unpaid. D. 45 days advance written notice. Answer. Correct answer. B. Explanation. Colorado law mandates that for non-payment of premium, a commercial policy cancellation requires at least 10 days written notice to the insured. For other reasons, 30-day notice typically applies. This rule protects insureds by giving fair opportunity to cure or seek alternatives. CRS SS104110.5 specifically addresses these notice requirements in commercial policies. Ref. CRS SS104110.5 are Colorado DOI Cancellation Notice Guidelines. Question 23. Among the various elements in an insurance contract, which one is demonstrated by the insurer promising to pay claims in exchange for the insured's premium payment? A. Offer. B. Consideration. C. Acceptance. D. Legal purpose. Answer. Correct answer. B. Explanation. Consideration is the value exchanged in a contract. Here, the insured pays a premium and the insurer promises to pay covered claims without consideration, contracts are unenforceable. The offer is usually the application or proposal. Acceptance is the insurer's approval, and legal purpose ensures the contract's intent is lawful. Colorado contract law aligns with general contract principles in insurance. Ref. C. RS. SS 42201. Colorado Insurance Contract Law. Question 24. In light of recent developments, Istasingh is reviewing his commercial general liability policy and wants to understand the supplementary payments provision. Which of the following is covered under supplementary payments? A. Settlement of claims without insurer consent. B. Insurer's legal defense costs and up to $250 for bail bonds. C. Payments for punitive damages awarded against the insured. D. Costs related to property damage repair. Answer. Correct answer, B. Explanation. Supplementary payments cover defense costs, bail bonds up to $250, loss of earnings, and other expenses incurred by the insured at the insurer's request. It does not cover punitive damages or claim settlements without insurer consent. This provision helps the insured with certain incidental costs beyond policy limits. Colorado insurance statutes require clear communication of such benefits. Ref. Our CG01, Colorado DOI liability coverage regulations. Question 25. When analyzing the risks involved, what distinguishes a peril from a hazard in commercial insurance? A. Peril is a condition increasing risk. A hazard is the cause of loss. B. Both terms mean the same in insurance. C. Hazard increases the chance of loss. A peril is the actual cause of loss. D. Hazard refers to covered losses. A peril refers to uncovered losses. Answer. Correct answer, C. Explanation. Perils are the direct causes of loss, e.g. fire, windstorm. Hazards are conditions or situations that increase the likelihood or severity of a loss, e.g. faulty wiring, poor housekeeping. This distinction is critical for underwriting and claims evaluation. Colorado insurance exam standards emphasize understanding this concept to correctly assess risk exposure. Ref. NAIC Insurance Fundamentals, a Colorado exam guidelines. Question 26. In the context of Colorado insurance law, how does the principle of indemnity limit recovery in a commercial property loss? A. The insured may receive payment exceeding the loss if agreed upon. B. The insurer pays only for actual financial loss, preventing profit. C. It allows replacement cost payment without depreciation for all claims. D. Indemnity requires the insured to pay a deductible first. Answer. Correct answer, B. Explanation. The principle of indemnity restricts recovery to the actual financial loss suffered, preventing the insured from profiting from insurance. This ensures fair loss distribution and helps control insurance costs. Colorado regulations require insurers to apply indemnity principles fairly, with exceptions only when agreed value or replacement cost endorsements apply. Ref. Colorado Revised Statutes SS 0110.8 ICP 010. Question 27. According to Colorado commercial insurance regulations, what is the purpose of the Commercial Insurance Guarantee Association? A. To guarantee insurer profitability. B. To protect policyholders if an insurer becomes insolvent. C. To regulate premium rates charged by insurers. D. To provide legal representation for insureds. Answer. Correct answer, B. Explanation. The Colorado Insurance Guarantee Association exists to protect insureds and claimants when an insurance company becomes insolvent and cannot fulfill its obligations. It pays covered claims up to statutory limits and promotes market stability. It does not regulate premiums or provide legal services. Ref. C. RS. SS 103501 et sec. The Colorado Guarantee Association Act. Question 20. From a practical standpoint, Mr. Thompson's commercial policy includes deductible clause. How does deductible affect the insurer's and insured's obligations in loss? A. Deductibles reduce the insurer's exposure by transferring some loss to the insured. B. Deductibles allow the insurer to deny claims without investigation. C. Deductibles are paid by the insurer before claim payment. D. Deductibles are only applicable in liability claims. Answer. Correct answer, A. Explanation. A deductible requires the insured to pay a specified amount before the insurer pays the remainder. This reduces moral hazard and claims frequency by incentivizing the insured to avoid small claims. Colorado commercial policies may feature deductibles for property and liability claims alike. The insurer cannot deny claims arbitrarily due to deductibles. Ref. ICP Euro 10, the Colorado Deductible Regulations. Question 29. Upon closer examination, how does the loss payable clause in commercial property policies benefit a mortgagee? A. It transfers ownership of the property to the mortgagee. B. It requires the insurer to notify the mortgagee of any policy cancellation. C. It eliminates the need for the mortgagee to pay premiums. D. It waives the insurer's subrogation rights against the mortgagee. Answer. Correct answer. B. Explanation. The loss payable clause or mortgagee clause protects the mortgagee's financial interest by requiring the insurer to notify the mortgagee of policy cancellation, non-renewal, or changes. It also ensures that claim payments are made to the mortgagee if their interest is affected. It does not transfer ownership or waive subrogation rights. This clause is standard in Colorado commercial property policies involving fine properties. Ref. ICP 010, Colorado Mortgagee Clause Regulations. Question 30. Given the circumstances of a fire at a commercial printing company, which of the following is a valid reason for an insurer to deny coverage based on concealment or misrepresentation? A. The insured failed to disclose a previous fire loss history. B. The insured did not provide proof of insurance on time. C. The insured reported the claim late by 1 week. D. The insured requested policy endorsement after a loss. Answer. Correct answer. A. Explanation. Concealment or material misrepresentation occurs when the insured intentionally withholds or misstates facts that affect underwriting decisions, such as previous losses or hazardous conditions. Failure to disclose a prior fire loss is material because it influences risk assessment. Late claim reporting or endorsement requests generally do not justify denial. Colorado law supports insurer rescission or denial. Material misrepresentations are proven. Ref. C. S. SS 10411.5 RCP 010.